Let's discuss now. Chetan Ahya, chief economist and global head of economics at Morgan Stanley, joins us. And Matthew Diczok, fixed income strategist at Merrill and Bank of America Private Bank. Gentlemen, good afternoon to both of you. Chetan, you're a little out of consensus here. You're expecting a 50 basis point cut.
That's
Why
right.
not 25?
Well, essentially, if you think about the Fed and its decision making right now, it's a dual mandate model that they're working with. Core PC inflation is working right now at 1.6%. And when you think about the job market, you have to think about the global growth outlook because we don't think the U.S. is immune to this global slowdown. So when you think about the job market, right now, the momentum is already slowing. And we think with the way the Capex numbers are, as you saw last week, Capex for the U.S. was down 0.6% in the second quarter. And the impact of the global slowdown will show further on the Capex numbers, further on the job market. So if the Fed wants to be preemptive, it needs to cut 50 basis points.
Matthew, why is he wrong? Why are you only going for 25?
Well, I wouldn't say cheating is wrong. He makes very good points. But it's a question of what you should do and what you're actually going to do. My wife thinks I should be clean around the house. My doctor thinks I should eat less red meat. None of those things are actually going to happen. The market is saying that it's going to be 25 basis points. You showed the implied Fed statistics just a second ago. That is right. They had a chance to guide the market to 50 just last week. Williams gave a speech. The implied change went to about almost 70% for a 50-basis point hike. And then the New York Fed came out 2 hours later and basically disavowed that statement, knocking the market expectations down to 25. They're carefully managing the market, so I believe they're going to go for 25, and that's the firm's call.
Well, there's also the data, which we're showing this tracker, and it's all been fairly positive lately. I mean, at least the biggies, like jobs, even firmer inflation numbers, retail sales, durable goods. It's kind of a controversial cut to begin with. There are members we talk to, like the Boston Fed president, who says the data is great. Why should we be cutting interest rates? So why would they go even farther into a cut?
Well, if you think about the key number that the Fed should be looking at and will be looking at, so not just should be, but will be looking at, is the Capex numbers. Now, when you think about the neutral rate or the rate at which the economy is not either overheating or is not too weak, is going to be influenced by what the Capex numbers are doing, and therefore it will be the key determinant that the Fed will be looking at. So we think the neutral rates are declining because Capex is very weak. And when you think about the outlook of that Capex, look, the multinationals in the U.S., the corporate sector in the U.S. is thinking about what's happening globally and taking its Capex decision. And when you think about the global outlook, look at some of the numbers like manufacturing PMIs or, for that matter, global trade volume. Those are at 2015-16 lows.
It's not a majority of our economy. Our economy is consumer, and consumers doing okay. And they don't target specific parts of the economy.
When you're thinking about the economy, the job market and retail sales would be lagging. What is leading is Capex and corporate profitability, and that's already deteriorating. So it has got to be with an outlook in the mind, not just looking at the trailing data. And we think the Fed is moved around to be thinking about the outlook in a forward-looking manner. At the same time, we think the Fed also appreciates the point that Janet Yellen mentioned, that the U.S. is not an island economy. It is pretty much linked to the global economy. And look, in this cycle, there was some bit of divergence in the global outlook and the U.S. growth. And that was because of the tailwind of fiscal policy. But now that tailwind of fiscal policy is fading, and we are beginning to see the impact in a few sectors right now already. We think this will get more broad-based. And so the Fed needs to get in ahead of the game, and we think they will. And that's exactly what the top three policymakers, including Powell, William, and Clarida, have been in their speech last week mentioning this. So I think as regards the clarification that was issued, I'm not sure exactly how that clarification came, but it was to a prodded question. If I ask you as a question, as Williams, is this statement in context of the upcoming monetary policy? Obviously, you're going to say no. That's how that clarification has come. It's not as if there was a proper clarification to say that, oh, no, don't read this statement in the context of the immediate policy.
No, but it is the first time the New York Fed has issued a clarification of that, and they've been so careful to micromanage markets. I would be very surprised if they weren't trying to knock that 50-bit percentage back down from 70 to 20 where it is now. I think they tried to do that, and I think they got it right.
What did you
but Clarida did push back.
What did you make, Matt, of Janet Yellen weighing in as well? Was that something designed to help Chair Powell?
I don't think it was designed to help. It's a good thought. I don't think so, but I do agree with her premise that she did say the U.S. is not an island, right? End of the day, we like to say, if you've ever been to Frankfurt before, you're never confused with Vegas, right? What happens in Vegas stays in Vegas. What happens in Frankfurt doesn't stay in Frankfurt. The disinflation there, right? The policy in Europe, that disinflation.
That should be Lagarde's new slogan.
I like that.
There you go. That's Lagarde's new slogan. That disinflation will affect the U.S. So again, we do believe, right, to Chetan's point, they will cut not just once, twice, probably 3 times this year. But probably not this meeting. But again, it could happen. It certainly could be 50, but we think it's going to be 25.
Very quickly, Matt, is the market set up to be disappointed?
The market is set up to be disappointed. What you're going to see is 1 to possibly 3 dissents. The stock market generally doesn't like dissents. And again, when there's a 20% chance of a 50 bip hike and they don't do 50, you're set up to disappoint the market.
Chetan, just quickly, we're running out of time, but big sell-off in sterling today. What's the likelihood of a no-deal Brexit, and would that affect the U.S. market and economy?
Well, we think it's still going to be an orderly Brexit. Either there will probably be elections before any risk of disorderly Brexit. In terms of its impact on the global economy in the U.S., I think it's relatively small, but it will definitely add to this whole problem that we're seeing from the global side on trade policy. And now this will be the additional uncertainty that will influence the U.S. and the global corporate Capex sentiment.